Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the S&P 500 ETF, ticker symbol SPY. And if you've been following along with my reports, you'll know that I leave my lines on the chart from the previous week so you can see how the forecast worked out. And last week I drew this line saying that we would most likely rally up to test this 20-period moving average and then move right back down. And the end of the line right there is my price target. And you can see that when I highlight that, you'll see a little box pop up. The end of the line is 462.21. And that's exactly where we wound up. Now, what does that mean for next week? Well, if you'll notice, we had a slight drop in volume today on the way down. At one point, we had gap down, and it was looking pretty ominous for the S&P, but then towards the end of the day, we rallied up. You can see here on the intraday chart, the 1 minute chart, we rallied right up from 1 o'clock right up into the close, set new highs for the day, and we wound up on the highs. So I do believe that we'll have one day next week, Tuesday, that we will rally up and retest that 20-period moving average. Now, I wouldn't get too bullish on this one because if we rally up to test that 20-period moving average, guess what? That moving average is most likely going to act as a resistance point. And because the market is closed on Monday for Martin Luther King Day, I do believe that we're going to see selling towards the end of the week. Now, I'm not going to put that forecast on just yet until we hit the moving average as resistance, and again, that's my forecast for S&P. Now, the other reason why I'm slightly bullish on Tuesday, possibly Wednesday, is because of the VIX. If you look here, again, I leave my lines on the chart. I did a short-term forecast and then a longer-term forecast. So I'll zoom in a little bit more because it's hard to see. Again, right here, I said the VIX would most likely drop and then rally with the end of my line right there, which I call a zip line, being my target. And that's exactly what happened. We hit that target yesterday, and today we have this long shadow above the VIX and a bearish harami. That's when you have this small red candle inside the previous green body candle. So next week, I think the VIX is going to drop slightly, just like that, and then I think we'll be right on our way back up in a similar angle to what we had here this week. Now, because the VIX, for the most part, is inversely related to the S&P, the drop in the VIX on Tuesday, possibly Wednesday, could add some pressure to the upside on the S&P, and so they're working hand in hand. Something that I would keep on your watch list. My longer-term target right here is set for the end of the month, particularly January 23rd, or I think the VIX is going to wind up there close to 26. To be exact, that's 25.71 for those who are keeping score. So that's the VIX. Now let's go on to the Qs. I'm going to take a quick break in between the Qs and IWM as I explain what's going on here. Again, I was very specific last week in saying I'm not getting crazy to the downside. I'm being conservative when I say 376.02. I said that last Friday. Remember, here was Friday. We had a bearish engulfing. We had Monday, Tuesday, Wednesday, Thursday, and then today. Today we closed at this area right here at my target, but we actually hit it right away on Monday. And so this is a nice looking candle again for the short term, so I think we're going to see a bounce in the Qs. But again, this 20-period moving average right here is heading lower, and that's going to act as resistance. Now, here's what I want to point out to everyone. If you go to my Twitter page, you'll see right there, pinned to the front of the page right there, is an article from the Wall Street Journal. And it's very interesting because it shows the number of tech stocks, more or less, that are reaching 52-week highs versus those that are reaching 52-week lows. And you could see here that we had 102 stocks as of today hitting their 52-week highs. But if you look down below, look at the number of 52-week lows right here. See, so the 52-week lows are outnumbering the highs. And again, if you go back to my Twitter page, there's another statement here. 334 companies trading on the New York Stock Exchange recently hit 52-week low. But that is more than double the stocks that have hit their 52-week high. Now, that has only happened 3 other times in the history of the market. And all of those 3 other times occurred in December of 1999, right before the crash. Now, this was right after I had made my forecast of calling the top in 2000 with the tech bubble. I'm on record for that. And so I see this happening all over again. History is repeating itself. And I just want to take time to note that, because the new 52-week highs versus new 52-week lows gives us more or less the breadth of the market in another sense, outside of volume. And it's really going to change if this moving average doesn't start heading up. And in order for that moving average to start going up, the price is going to have to start trading above that moving average. And I just don't see that happening in the short term. So again, to reiterate, my upside target is short term, Tuesday, possibly Wednesday. I have a target up there at the moving average, which is going to be right there in the box at 386.87. And then I think it's going to be watch out below. So keep your stops in place. All right, now IWM. This is interesting because I have a long-term target to watch out for, which is the 210 level. That's a key support level for IWM. If you look back here, that market has been bouncing off that quite consistently, and it looks like we're doing it once again. If you look at the low today, we came very, very close to hitting that at 210.58. So $210.58. We're 58 cents away from touching it. We're further away from closing below it. However, I do think we're going to see a bounce in IWM up to that moving average, and it's going to be the same story all over again. I think that moving average is going to act as resistance, and then I think we're going to start turning lower. Now, I'm going to forecast this further out like this. I'm actually going into March, and I'm going to keep that in place, that longer-term target. I do believe that we're getting very close to breaking out below that 210 level, and I have an IWM target of $201.32. That is in the middle of March, so we're about two months away from that target. But I'm going to leave that in there just as a point of interest for folks who are interested in learning how to forecast longer term. All right. Now, the diamonds. This is the ETF for the Dow Jones Industrial Average, and this is very interesting because last week, if you recall, I said this is the first time that I've ever done this on a weekly market report. I do it all the time on my Oracle Hour call on Wednesdays, where I do a rapid fire stock analysis of anywhere between 30 and 50 stocks in an hour. And I often do this where I point out the ABCD pattern. And what I did last week is I said, okay, here's A to B in the ABCD pattern, A to B, B to C, and I forecasted this out. Remember, none of these candles were here. I said we will go up to C and then come back down to D. Now, we're in the process of coming down to D. Now, while we're selling off today, you'll notice there is a small gap right there. I think next week, I'm going to leave this in place, but I'm going to show you what I expect to see next week. Next week, I think we're going to go right up to fill that gap, test the moving average, and then get right back on track for hitting point D in this four-legged pattern known as the ABC pattern. It's a zigzag pattern that many traders trade against. So when we get down to this level here, right around 355, I think you're going to see some short-term buying coming in, and then we'll see another zigzag forming as we start to reach for this open gap down below the market. Now, I took a lot of time analyzing that, but I want to keep that in place. And again, record this for the record so that you can see that the downside target ultimately for next week is going to be somewhere around 355.18. So that is for the diamonds. Now, finally, last week I analyzed Ethereum, ticker symbol ETHE, and I said we would most likely start to rally. You can see here, this was Friday. We breached this support level briefly and then started trading up. I do believe we're going to continue upward right here like this and ultimately hitting that target. We'll have to see whether or not that target is reached next Friday. Again, a short trading week. But that moving average, again, like the other markets, are going to reach that resistance level. And we also have a gap fill that has filled, but it's acting as resistance. So this whole area in here is going to act as a resistance area. If we break out, that's great for those who are in the crypto market. We could see a breakout rally. If not, then I would keep your stops in place and definitely keep your stops somewhere below that low, below 24. So that is it. If you are happy with this report, then please click the like button, subscribe to the YouTube channel, and of course, if you hit the notification bell, you'll get notified when this alert goes out every Friday. So with that, have a great long weekend, and we'll talk to you next week. So long.